Today we're breaking down a powerful take from Tom Lee who says this market is headed higher, but there's a catch investors need to understand right now. He recently joined CNBC's Closing Bell to talk about where stocks are going next, what's really driving this surge in earnings growth, and why this rally may still have more room to run. I'm going to show you the clip first, then I'll break down exactly what he said and give you my honest take. After that, we'll dive into 3 phenomenal AI stocks with serious upside potential. Let's hear what Tom Lee has to say.
Well, let's ask Tom Lee. He is Fund Strat's head of research, a CNBC contributor, and he is live as you see. Welcome back.
Great to see you, Scott.
Man, you nailed this thing. You really did. You had a sense that this market was coiled for a really big spring back, which we've had. So what do we do now?
Well, one, I think that the market's rising for the right reasons, Scott, because it's rising because the tail risks are abating and we've had good fundamentals. In fact, earnings have been good enough that estimates are going up. And the leadership is coming from the groups that we want to see, which has been the Mag 7 and the tech and the cyclicals. And that's what you want to see if the market is showing sort of economic resilience. So I'd say for now, our base case is tracking. We still think we're going to make a good move towards 7,300 for the S&P 500. And today we did raise software, which is also the ETF IGV, to beat a top pick sector alongside Mag 7 and crypto.
So let me ask you this. I hear you. Market's obviously rising for the quote unquote right reason. I mean, earnings growth in April, this is amazing, was projected to be 14.1%. Tom, we're clocking 28% earnings growth.
Yeah.
That's remarkable. That's why the market's been looking outside of the oil complex and away from the war and any of the other, rising rates from time to time. The market is just not having it because it's busy feasting on these earnings.
That's right, Scott. In some ways, it's showing you that revenue growth, which has been better, is delivering each dollar of upside to revenue is delivering a lot of earnings growth. So there is a margin story at work, which people would say is productivity, but it shows you the return on investment for the U.S. economy is also going up, meaning I do think that this is an example of AI actually having positive payoffs for the economy and for earnings.
Yeah, what about tech, Tom, and areas of the market that, to some at least, are starting to look overbought? And I'll get into that a little bit later in our A block here. But for example, 1 month, okay? In 1 month, the Nasdaq's up 15%. You've had a bit of narrower breadth in the market, to which Goldman's Ben Snyder today says sharply narrowing breadth has historically indicated equity market drawdown risk. S&P's up 14% from the low in March. The median S&P constituent, however, remains 13% below its respective high. How do you reconcile that?
I think that I'm going to look at this as a series of rolling bear markets because we know the Mag 7 and the software stocks peaked a lot earlier than the broader market did. And then they led into the low, but then bottomed first and are rallying. So I think that we should expect breadth to follow, but it would be pretty textbook because, tech is what peaked earlier, several months earlier before the index level market actually peaked.
I mean, we're almost at 7,300 as I ask you these questions. 7,238 is where I'm looking at right now on the S&P. Where are we going, Tom? You figured we'd get here because you said as much when you thought we hit the bottom. But, we've come so far so fast. Does that mean we've stolen some from the future and moved it forward? What does that tell us?
Well, I know strong markets tend to, and I'm going to sound not very original, but strong markets stay strong. So I think the strength that we've seen is a good sign. And we also know when we look at the data that institutional investors caught the bottom. But I think in 2026, it's retail that kind of missed the low, but they have a lot of firepower. So I think it's going to be a retail-driven buying of stocks. And that's why I think broadening can take place because, as you know, retail investors do like small and mid-cap stocks as well.
So right off the top, what stands out to me is how confident Tom Lee is that this rally is not just noise. He makes a very specific point that the market is rising for what he calls the right reasons. Now that might sound like typical bullish talk, but when you break it down, he's pointing to three core drivers: easing macro risks, strong earnings, and leadership coming from the sectors that typically drive durable bull markets. And honestly, I agree with part of that. But I also think this is where investors need to stay sharp, because right reasons doesn't always mean no risk. It just means the foundation is stronger than it looks on the surface. Let's unpack that. First, he talks about tail risks fading. That's a big deal. For most of the past couple of years, the market has been dealing with constant macro pressure. Inflation spikes, interest rate uncertainty, geopolitical tensions, especially around energy and war. And what Tom is saying here is that the market is essentially choosing to look past those issues because they're no longer escalating. That shift in psychology is critical. Markets don't move based on current conditions. They move based on what investors believe is going to happen next. So if fear is declining, even slightly, that alone can justify higher valuations. But here's where it gets more interesting. The real engine of this rally, according to Tom Lee, is earnings. And not just decent earnings. We're talking about a massive upside surprise. The expectation going into April was around 14% earnings growth, and what we actually got was closer to 28%. That is not a small beat. That's a complete repricing event. And this is where I think a lot of people are underestimating what's happening. When earnings come in that strong, it forces analysts to raise future estimates. That means the market isn't just rising because of optimism. It's rising because the denominator in valuation metrics is actually increasing. In simple terms, stocks can go up without becoming more expensive if earnings are rising fast enough. Now Tom takes it a step further and connects this to something bigger, which is productivity, and specifically AI. He suggests that what we're seeing is early evidence that artificial intelligence is not just hype, but actually translating into real economic output and margin expansion. And this is where I think he's making a bold but important call. Because if AI is truly driving productivity gains, then we could be entering a cycle where companies are able to generate more profit from each dollar of revenue. That's a structural shift, not a temporary one. Personally, I think this is directionally correct, but probably a bit early to fully confirm. AI is clearly boosting efficiency in some sectors, especially software and large tech, but whether that translates across the entire economy is still an open question. Now, speaking of tech, this is where the conversation gets more nuanced. The interviewer brings up something that a lot of investors are thinking right now, which is whether parts of the market, especially the Nasdaq Composite, are starting to look overheated. A 15% move in a single month is not normal. That kind of move usually triggers concerns about overbought conditions and potential pullbacks. And then there's the issue of market breadth. This is key. Even though the broader index like the S&P 500 is pushing toward new highs, the average stock is still significantly below its peak. That means a small group of stocks is doing most of the heavy lifting. Historically, that can be a warning sign. But Tom Lee doesn't see it that way. He frames it as a rolling bear market, which is actually a very interesting concept. What he means is that different sectors peaked and bottomed at different times. Tech and software corrected earlier, found their bottom earlier, and are now leading the recovery. So from his perspective, narrow breadth is not a red flag. It's just a phase in the cycle. And I'll be honest, this is where I partially agree, but I wouldn't dismiss the risk so quickly. Yes, leadership rotation is normal, but sustained narrow breadth over time has historically made markets more fragile. If leadership starts to crack, there isn't always enough support underneath to keep the index elevated. So while his explanation makes sense structurally, I think this is something investors need to actively monitor rather than just accept as textbook. Now the next part of the interview is where things get really interesting. The S&P is already approaching his target of 7,300, and the interviewer asks the obvious question: have we moved too far too fast? Are we basically pulling future gains into the present? And Tom's response is simple, but it carries a lot of weight. Strong markets stay strong. Now that might sound like a cliche, but historically, momentum is a very real force in markets. When conditions align, strong earnings, improving sentiment, institutional support, rallies can extend much further than most people expect. He also points out something that I think is extremely important, which is positioning. According to him, institutional investors were able to catch the bottom, but retail investors largely missed it. And that creates a very specific setup. Retail still has capital on the sidelines. That means there is potential fuel that hasn't even entered the market yet. And this is where I think his argument becomes compelling, because if retail investors start chasing performance, which they typically do once markets have already moved, that can create a second leg higher driven purely by inflows and momentum. But again, this cuts both ways. Late-stage retail participation has historically also been a sign that markets are getting closer to a short-term top. It doesn't mean the bull market ends, but it often means volatility is about to increase. So when I look at everything Tom Lee is saying here, the big picture takeaway is this. He believes we are still in the middle phase of a bull market, not the end. He sees strong earnings, improving macro conditions, and untapped retail capital as reasons why the rally can continue. And I think there's a strong case for that. But at the same time, there are clear pressure points forming. Narrow breadth, rapid price acceleration, and heavy reliance on a small group of stocks are all factors that can lead to sharp pullbacks even within a broader uptrend. So the way I see it, this is not a moment to be blindly bullish or overly cautious. It's a moment to be strategic. Stay invested, respect the trend, but don't ignore the signals underneath the surface. Because markets like this can keep going higher, but they can also move very quickly when sentiment shifts. And that's exactly why understanding interviews like this matters, because it gives you insight into how top strategists are thinking, but it also gives you a framework to challenge those views and make better decisions yourself. Now let's dive in and talk about the 3 phenomenal AI stocks that could deliver maximum upside as artificial intelligence reshapes the global economy faster than most investors realize. Let's start with the first one, and arguably the most dominant force in the entire AI ecosystem right now. That company is NVIDIA, ticker symbol NVDA. Before we even get into numbers, you need to understand why NVIDIA matters at a foundational level. This is not just a chip company. NVIDIA is the backbone of artificial intelligence. Every major AI breakthrough you've seen over the past few years, whether it's large language models, generative AI, autonomous systems, or advanced data analytics, is running on NVIDIA's hardware, and this is where the real moat comes in. NVIDIA has spent decades building a parallel computing ecosystem that goes far beyond just selling chips. Its CUDA software platform has become deeply embedded in the workflows of developers, researchers, and enterprises around the world. Once you build on CUDA, switching away becomes incredibly difficult. That creates a powerful lock-in effect that most competitors simply cannot replicate. Now think about what that means in the context of AI. As demand for AI computing explodes, companies are not just buying hardware, they are buying into an entire ecosystem. And NVIDIA owns that ecosystem at scale. This is why NVIDIA continues to dominate the data center GPU market, which is essentially the engine room of AI. Its GPUs are designed specifically for high-performance computing tasks, making them indispensable for training and running complex AI models. Now let's talk about growth, because this is where things get even more interesting. NVIDIA has been delivering extraordinary revenue expansion, driven largely by its data center segment. This is the part of the business tied directly to AI demand, and it has been growing at a pace that is almost unheard of for a company of this size. What's driving that growth is not just hype, it's real spending. Major cloud providers, enterprise customers, and governments are pouring billions into AI infrastructure, and NVIDIA is the primary supplier. That creates a situation where demand continues to outpace supply, giving NVIDIA strong pricing power. And pricing power is one of the most underrated drivers of long-term profitability. But here's where I want to add my own perspective. A lot of investors look at NVIDIA and think they've missed it. The stock has already run up significantly, and the immediate reaction is to assume the upside is gone. But that thinking might be too short-term, because if you zoom out, we are still in the early innings of AI adoption. Most companies are just beginning to integrate AI into their operations. Entire industries like healthcare, finance, manufacturing, and logistics are still figuring out how to fully leverage these technologies. And every step of that journey requires more compute power, which brings us back to NVIDIA. As long as AI demand keeps growing, NVIDIA remains at the center of that growth. Now, of course, no stock is without risk. One of the biggest concerns around NVIDIA is valuation. When a company performs this well, expectations get very high, and high expectations can lead to volatility if growth slows even slightly. There's also the question of competition. Other players are trying to develop alternatives, including custom chips and in-house solutions from large tech companies. But here's the reality. Building hardware is one thing. Building an ecosystem is another. NVIDIA's advantage is not just technological, it's structural, and that kind of advantage tends to persist longer than most people expect. Another factor to consider is how NVIDIA is expanding beyond just hardware. The company is actively developing software, networking solutions, and full-stack AI platforms. This positions it not just as a supplier, but as a comprehensive AI infrastructure provider. And that's a much bigger opportunity, because instead of capturing just one layer of the value chain, NVIDIA can participate across multiple layers. That increases both revenue potential and customer dependence. Now let's talk about long-term relevance. If AI becomes as transformative as many believe, and all signs suggest it will, then NVIDIA is not just a participant in that future. It is a foundational pillar. That's the kind of company that can compound value over time, even after significant short-term gains. But again, this requires a shift in mindset. Instead of trying to time the perfect entry or worrying about short-term fluctuations, the focus should be on understanding the magnitude of the opportunity and the durability of the business model. And in NVIDIA's case, both are extremely compelling. Personally, I see NVIDIA as a core holding in the AI space, not because it's the cheapest option, but because it has the strongest combination of dominance, scalability, and ecosystem control. And in markets driven by innovation, those qualities tend to win over the long run. Now here's something else that often gets overlooked. NVIDIA is not just benefiting from AI demand, it is actively shaping how AI evolves. Through its research, partnerships, and product development, the company is influencing the direction of the entire industry. That gives it an informational advantage. It knows where demand is going before most others do, and that allows it to position itself ahead of the curve. From an investing standpoint, that's incredibly valuable, because you're not just investing in a company reacting to trends. You're investing in a company helping to define them. Now let's bring this all together. You have a company with a dominant position in a rapidly growing market. You have strong revenue growth driven by real demand. You have a powerful ecosystem that creates high switching costs. And you have expanding opportunities across hardware, software, and infrastructure. That combination is rare, and when you find it, it's worth paying attention. But at the same time, discipline matters. Even the best companies can experience pullbacks. Even the strongest trends can have periods of consolidation. So the key is to approach this with a long-term mindset while staying aware of short-term risks. Because the goal is not just to buy great companies. It's to hold them through the cycles that allow their value to fully materialize. And NVIDIA, in my view, fits that profile. Now before we move on to the next AI stock that could deliver massive upside, here's something I want to say. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second company, and this is where things start to get really interesting because we're shifting from a dominant giant to a much smaller, under-the-radar player that could have explosive upside if it executes properly. The company is Nebius, ticker symbol NBIS. Chances are, most investors haven't even heard of this name yet, and that alone should get your attention, because in markets like AI, some of the biggest gains don't always come from the obvious leaders. They often come from emerging companies that are building critical infrastructure before the crowd fully understands what they're doing. So what exactly does Nebius do, and why does it matter? At its core, Nebius is focused on AI cloud infrastructure. Think of it as part of the digital backbone that allows companies to train, deploy, and scale artificial intelligence models. If NVIDIA is supplying the raw computing power, companies like Nebius are helping businesses actually use that power efficiently. And this is a massive opportunity, because as AI adoption accelerates, demand is not just increasing for chips, it's increasing for the entire ecosystem that supports those chips. That includes cloud platforms, data processing, storage, and specialized AI environments that make it easier for developers and enterprises to build and run models. This is where Nebius positions itself. Instead of competing directly with the largest cloud providers, it is focusing on AI-specific infrastructure. That means optimized environments for machine learning workloads, high-performance computing, and scalable solutions tailored to AI use cases. And here's why that matters. General-purpose cloud platforms are not always the most efficient solution for AI. These workloads are extremely resource-intensive and require specialized configurations. Companies that can offer optimized AI infrastructure have the potential to capture a very specific and growing niche. Now, from a growth perspective, Nebius is still in the early stages, which means you're not looking at the same level of financial maturity as something like NVIDIA. But that's also where the upside comes from. Early-stage companies in high-growth sectors can scale very quickly if they gain traction, and according to the data, Nebius is benefiting from increasing demand for AI-related services. As more companies look to build AI capabilities, they need infrastructure partners that can support those efforts without the complexity of building everything in-house. That creates a tailwind. Now I want to be very clear about something here. This is not a low-risk investment. Smaller companies come with higher volatility, less predictable revenue streams, and greater execution risk. Nebius still has to prove that it can scale efficiently, compete effectively, and maintain customer growth over time. But that's the trade-off. Higher risk often comes with higher potential reward, and this is where I think Nebius becomes interesting from a portfolio perspective. If you already have exposure to established leaders like NVIDIA, adding a smaller high-growth name like Nebius can give you asymmetric upside. In other words, the potential gains could significantly outweigh the initial investment if the company succeeds. Now let's talk about what could drive that success. First, the continued expansion of AI workloads. As artificial intelligence becomes more integrated into business operations, the demand for infrastructure will increase. Companies will need faster processing, more storage, and more efficient ways to manage data. Second, specialization. Nebius is not trying to be everything to everyone. It is focusing specifically on AI infrastructure, which allows it to tailor its offerings more precisely. That can lead to better performance, lower costs, and stronger customer relationships within its niche. Third, strategic positioning. Being early in a growing market gives Nebius the opportunity to establish itself before competition intensifies. If it can build a strong reputation and customer base now, it could benefit from long-term network effects. But again, execution is everything. The company needs to continue investing in its technology, expanding its capabilities, and attracting clients. Without that, the opportunity remains just that, an opportunity. Now here's my personal take. I think Nebius represents the kind of stock that can either become a breakout winner or struggle to gain traction. There's not much middle ground, and that's why position sizing matters. This is not the type of stock you go all in on. It's the type you include as part of a broader strategy, where you're willing to accept volatility in exchange for potential outsized returns. Another thing I find compelling is how the market tends to overlook infrastructure plays like this until they reach a certain scale. By the time everyone is talking about them, a lot of the upside has already been captured. So getting in early, if the thesis is correct, can be a major advantage. But again, patience is key. Companies like Nebius don't become successful overnight. It takes time to build the technology, secure customers, and scale operations. Investors need to be willing to hold through uncertainty. Now let's also consider the broader AI landscape. As more companies adopt artificial intelligence, the ecosystem becomes more complex. You have hardware providers, software developers, cloud platforms, and specialized service providers all interacting with each other. Nebius sits right in the middle of that ecosystem, and if it can position itself as a reliable, efficient infrastructure provider, it could become an important piece of the puzzle. That's the kind of positioning that can lead to long-term growth. But it's not guaranteed. Competition will increase. Larger players may enter the space or expand their capabilities, and market conditions can shift. So the key is to continuously evaluate the company's progress. Is it growing its customer base? Is it improving its technology? Is it moving closer to profitability? Those are the questions that matter, because at the end of the day, investing is about probabilities, and with Nebius, you're betting on the probability that it can capture a meaningful share of a rapidly growing market. Now before we move on to the third and final AI stock, which might be the most futuristic of them all, here's something I want to share with you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's get into the third and final company, and this one is easily the most futuristic of the three but also one of the most misunderstood. The company is IonQ, ticker symbol IONQ. If NVIDIA represents the present of AI and Nebius represents the infrastructure layer that supports it, then IonQ is a bet on what comes next. Because what IonQ is working on goes beyond traditional computing entirely. We're talking about quantum computing. Now, before you tune out thinking this is too technical or too far into the future, let me simplify why this matters. Classical computers process information in bits, which are either 0 or 1. Quantum computers use qubits, which can exist in multiple states at the same time. That allows them to solve certain types of problems exponentially faster than traditional systems. And here's the connection to AI. As artificial intelligence models become more complex, the computational requirements increase dramatically. There are limits to what classical hardware can handle efficiently. Quantum computing has the potential to break through those limits. That's the long-term vision. And IonQ is one of the few companies actually building commercial quantum systems today. Now, what makes IonQ different is its approach. Instead of using superconducting qubits, which many others are exploring, IonQ uses trapped ion technology. This approach is known for its stability and accuracy, which are critical factors in quantum computing. And that gives IonQ a potential advantage in building systems that can perform meaningful computations reliably. But let's be clear about something. This is not a mature market. Quantum computing is still in its early stages. Revenue is relatively small compared to traditional tech companies, and profitability is not the focus right now. This is about building capability, and according to the data, IonQ has been making steady progress in advancing its technology and expanding its partnerships. The company is working with major organizations across industries, exploring real-world applications of quantum computing. That includes areas like optimization, cryptography, drug discovery, and complex simulations. These are problems that classical computers struggle with, but quantum systems could potentially solve much more efficiently. Now, from an investment standpoint, this is where things get very interesting. IonQ is not being valued based on current earnings. It's being valued based on future potential, and that creates both opportunity and risk. The opportunity is obvious. If quantum computing becomes commercially viable at scale, companies like IonQ could see massive growth. We're talking about a completely new computing paradigm with applications across multiple industries. That's the kind of shift that can create enormous value. But the risk is just as real. There is no guarantee that quantum computing will scale as quickly as expected. Technical challenges remain, competition is increasing, and timelines are uncertain. This is not a predictable growth story. It's a high-conviction bet on a transformative technology. Now here's my personal take. I see IonQ as a long-term option on the future of computing. It's not something you buy expecting immediate returns. It's something you hold as part of a forward-looking portfolio, understanding that it could take years for the full potential to materialize. But if it does, the upside could be significant, and this is where diversification within the AI and advanced computing space becomes important. You have NVIDIA dominating the present, you have Nebius building the infrastructure layer, and then you have IonQ exploring the next frontier. Each plays a different role, each has a different risk profile, and together they give you exposure to multiple dimensions of technological growth. Now let's talk about what to watch going forward with IonQ. First, technological milestones. Advancements in qubit stability, error correction, and system scalability are critical. These are the indicators that the technology is moving closer to practical use. Second, partnerships and commercial adoption. As more organizations begin to experiment with quantum solutions, IonQ's ability to secure and expand partnerships will be key. Third, revenue growth. Even though it's early, consistent increases in revenue can signal that the company is moving from experimentation to real-world application. Those are the signals that matter, because in emerging technologies, progress is not always linear. There will be breakthroughs, setbacks, and periods of uncertainty. Investors need to stay focused on the long-term trajectory rather than short-term noise. Now let's zoom out and bring everything together. We just covered 3 very different companies, but they are all connected by one theme. Artificial intelligence and advanced computing are reshaping the global economy, and these companies are positioned at different points along that curve. NVIDIA is the dominant force powering today's AI systems. Nebius is building the infrastructure that enables broader adoption, and IonQ is pushing the boundaries of what computing can become. Now here's the question you need to ask yourself. Which of these companies has the strongest long-term advantage? Is it the established leader with proven dominance? Is it the emerging infrastructure player with high growth potential? Or is it the futuristic innovator that could redefine the entire space? I want to hear your thoughts in the comments, because understanding different perspectives is one of the best ways to become a better investor. And before we wrap up, here's something for those of you who want to go deeper. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.